The disaster du jour in the stock market actually has a bit of an Iran component. That would be Accenture, the IT consulting biggie. Not as big as it was yesterday. Shares are getting kneecapped, down 18% at the moment, after the company revealed it took a $400 million hit to its Middle East business in the third quarter and slashed its revenue and current quarter sales forecasts. Accenture, the worst S&P stock right now, but you got to look at the ripple effect here. Cognizant is the second worst performer on the S&P, and IBM is the biggest Dow laggard. You've got Cognizant down 9.2%. IBM is getting hit to the tune of about 4.8%. Both are in the IT consulting business and are getting swamped on the perception they might take an indirect hit as well from the Iran war. No guarantee on that, but that's how markets work and that's how investors think. All right, so you're starting to see the Iran war lag now catching up in at least some of the earnings calls, and yet the AI hot hand trade continues. Should you continue to follow? Let's get right to the floor show with $403 billion in assets under management. Brent Schutte is Northwestern Mutual Wealth Management CIO. And Brent, you're saying the U.S. large cap companies, and I would imagine that encompasses big tech, may look really enticing, but they now have an elevated risk. How long have you had an underweight position in U.S. large caps?
For a little while now. We prefer more of an equal weight S&P 500, so taking away some of the risk of concentration in those 10 names. So think about the Mag 7 and the other tech names that have really become an elevated part of that index, and moving it more towards an equal weight, which is essentially just democratizing a bit more the exposure in the S&P 500. Look, we think there are better opportunities in U.S. mid and small cap for longer-term focused investors. We think the economy will broaden back out, which will broaden back out the markets. And that's where, if you have an intermediate to long-term time horizon, that's where valuation matters. And this is where there are cheap parts of those markets, which we think will benefit from the AI becoming more a part of those companies and what they actually can do to increase the profitability and productivity of their workers. And that's actually playing out this year. Despite all the attention on tech, U.S. large cap, U.S. small and mid cap are actually outperforming quite handily this year.
Yeah, in fact, not just this year. You point out that small and mid caps over the past 26 years, so since 2000, have actually outperformed, even in the last couple of years, annually. So on your screen, folks, what I want you to understand is the annual return since 2000, U.S. small and mid caps, 9.6% per year. Again, this is average, right? U.S. large caps, 7.7%. So it's almost as if it's better if you have the broader part of the market versus just that air, compressed air at the very tip of the spear.
This is where I think there are echoes of 1999, and that's not to scare people, but merely more of a reality of where we were back then, which was in a similar period of transformation with the dot-com era. Plus, we had a lot of Y2K spending, and that had pushed technology stocks higher, and that had pushed the S&P 500 much higher because that's where they resided. Over the next few years, and in fact, as you mentioned, the last 26 years now, that is where you have seen valuation matter. Those stocks back then were cheap relative to large caps, same as they are today. And that's where I think if you think about the longer term, you want to focus on valuation. And that's where I think there are opportunities no matter what happens in the coming months and quarters with Iran, with AI, with whatever the Fed is going to do or not do.
Yeah, but you don't want to leave money on the table, and you don't want to leave gains on the table. You look quarter to date at, say, for example, the Amazons of the world, or, I mean, I was just checking, it was Amazon, it was NVIDIA, it was Oracle. I mean, they've had dangerous moments, certainly, over the past 6 to 8 months, but nice moves here. Amazon up 16% quarter to date, NVIDIA up 20%, Oracle up 25%. I get exactly what you're saying, and it's certainly a cautious and smart way to do it, but I mean, you don't want to miss out on that momentum trade.
I mean, certainly you can pick it up in different ways. That's where I would be just a bit cautious about not leaving money on the table, but not also losing money and losing quite a bit of money. This is where concentration can make you magnificently wealthy. It can also, and more likely, make you magnificently not wealthy.
Yeah,
my job is individual investors from point A to point B to point C. And the way you do that is by not losing a ton of money like you did if you concentrated back in 2000, where you saw the technology sector of the S&P 500 fall 80%, and then spend 17 years before breaking even. And this is where I encourage people to think about not only returns, but also risk. And that's where I think diversification is not only going to be a risk management tool going forward, but I think much as we've discussed earlier, it will be a return enhancement tool going forward, as I expect those other parts of the market to do much better in the coming years.
Absolutely. I completely agree with you. But if you know certain things, it is known that there is a shortage of memory and storage, which is desperately needed for all of these chatbots and everything that's going on in the AI data centers. And it will take a while to work through that shortage. You look at the big names here, SanDisk, Seagate, Micron, Western Digital, those are all, Marvell, all at record highs, and could be a rough ride, but still, you know that it'll take a while for that shortage to finally be ameliorated, and therefore, isn't it almost a safe bet to at least go into some of those?
We'll see. That's where the market discounts many years into the future. And the one thing about capitalism is that it has a way of satiating what appears to be insatiable right now, which is that demand for memory chips, which are more of a commodity type of exposure. Look, this is where I encourage people. I'm not telling you to sell out all those things. My biggest fear is that people are concentrating in those things like they do at the end of every economic cycle or close to the end when one sector or segment catches their fancy. At least historically, this is where I believe you are much better off from a risk and return perspective, just by spreading your bets around and not putting all your eggs in one basket, which is kind of a return to what we used to talk about on TV shows like this.
How are you viewing the froth or excitement around these IPOs? SpaceX is down right now about 6.33% after falling yesterday. So it's coming a little bit off the boil, but it is still well above the $315 that it was priced at per share. But you look at a little bit of gravity taking hold with SpaceX at the moment, and it does continue a little bit of a retreat here. How do you feel about where successful investors really make the difference between themselves and those who get too caught up?
I think just your last comment, not getting too caught up. Certainly, it is a company that I think offers promise, but it doesn't do that right now. It doesn't have a lot of earnings or revenue. And this is where I just think going forward, you want to make sure you have a balanced portfolio.
Brent, thank you. Good to see you.
Thank you.
Brent Schutte.